Hi, I'm Ken Mann, the Senior Managing Director at Heritage Equity Partners. Thanks for joining our video series. Here we'll endeavor to do short interviews with industry experts to tease out information on topics that should be of interest to you. Each interview will be very brief, but will be filled with nuggets of useful information to you. If you feel that you need to take a deeper dive on today's topic, please contact me at the email address below or phone number below, and I'll connect you with today's industry expert. Thanks very much, and I hope you enjoy today's interview. Let's jump into today's topic and meet our guest expert. Today, I'd like to explore what a secured creditor can do with a stubborn or in denial borrower to get him to take some action to find a resolution to a distressed credit. With me today is Erik Anderson, my friend and a partner at the law firm of Parker, Hudson, Rayner, and Dobbs in Atlanta, Georgia. Erik is originally from Madison, Wisconsin, and is also admitted to practice there. He concentrates his practice in bankruptcy, workouts, financial restructuring, and commercial finance. He regularly represents banks, financial institutions, secured asset-based lenders, and other parties in bankruptcy and restructuring matters. This includes representation in workouts and restructuring in and out of bankruptcy, including negotiating and closing asset-based loans, debtor in possession financing, loan collection and enforcement, purchase and sale of assets of distressed companies, and various related transactions. Erik's deep experience includes representing the Chapter 7 trustee in the case of Silverton Financial Services, Inc., the largest bank holding company bankruptcy in Georgia, and he's currently representing the senior secured lenders in the Chapter 11 case of Noranda Aluminum in St. Louis. Erik represented Bay Harbor Homes, LLC in its Chapter 11 case, as well as publicly traded Vesta Insurance Group, Inc., and J. Gordon Gaines, Inc., which is an insurance holding company and its management subsidiary in their Chapter 11 case. Erik has been an author for the ABI Journal, has penned various articles including You Can't Bootstrap Yourself into a Bankruptcy Court and Tax Sharing Agreements and Refunds. Are tax refunds property of the estate? Very stimulating titles there, by the way. He and his work have been honored and awarded much more than I can possibly cover here today. Erik, thanks for joining me here in Washington, D.C. at the ABI spring meeting.
Pleased to be here.
So you're representing a lender. Your client's borrower is in financial distress, but management is in denial and paralyzed. What are the first steps a lender should take to get that borrower's attention?
Well, Ken, it kind of depends on the amount of financial distress or the level or degree of financial distress the borrower finds itself in. If the distress is severe, that may help take care of itself. If they can't make payroll or if they can't pay for supplies, their financial distress is going to be apparent to them, and they may come to the lender asking for help because the lender isn't going to fund. In other situations where things are spiraling downhill, perhaps a covenant has been tripped, or the lender is able to determine from reviewing financials that the borrower's prospects are not good. If the borrower is not noticing that itself, it probably works best to have what we refer to as sort of a come to Jesus meeting with the borrower, to explain the lender's concerns, to explain perhaps if there's imminent defaults that are about to come up because of a covenant that may be tripped, and to lay out for the borrower that we, the lender, look at your situation with objective eyes, and it isn't perhaps jaded by the fact that we're management or that it's our company, and that these issues need to be addressed promptly, or else they're going to have a hard time to get enough working capital to operate.
And so, what can a lender do, or what leverage is available to a lender to get the borrower to do something, like hire an intermediary, hire a turnaround consultant, maybe even hire a liquidator?
Well, similar to what we talked about a minute ago, the leverage may be that if the company is out of their availability, if there is a default that may be triggered, or already has been triggered, or will be triggered, the lender doesn't have to lend. It's important in this to remember as a lender that the lender is not running the business. The lender is lending money or not. And that's where its leverage comes from, is to say, unless you have met all of the conditions that we have set forth in the loan documents, we don't have to lend you this money. And you may have a payroll coming up, you have suppliers you have to pay, you may have other payments that are due, and we cannot tell you how to run your business, but what we can tell you and what we have the leverage over is whether we're going to lend you any more money for you to operate. And that if you don't take steps to right the ship, if you don't take steps to give us confidence in your management ability, we may not be able to lend you any more money.
Understood. You mentioned not running their business. What are the sort of key no-nos? Definitely don't do this as a lender to avoid legal problems.
Well, when you think about lender liability concerns, the key word really is control, and that a lender wants to avoid even the appearance of controlling the operations of the debtor. So again, the lender needs to put itself and remind itself that what it is in control of, and all it is in control of, is whether or not it lends money to the debtor or borrower, and whether or not it exercises remedies if there was a default. The lender does not run the business. The lender does not hire and fire employees. It does not make strategic decisions about what sorts of business lines it may want to follow or not. It doesn't make purchasing decisions. It does not make decisions who they're going to pay between creditor X and supplier Y and vendor Z. Those decisions, once a lender inserts itself into those decisions and begins to sort of take control of the business, that is what frequently opens the door to lender liability cases. A creditor who remains unpaid may start to try and pin the blame on the lender. If they don't get paid, if the business spirals downhill, anybody who's been in control of the checkbook, in a sense, may be in the line of fire.
Understood. Frequently when we come to a deal, the company is operating under a forbearance agreement, and the length of which tend to vary pretty significantly. What are some of the key factors, like seasonality or perhaps inventory losing value, or the business being the proverbial melting ice cube? What are the key factors that would help you determine what's an appropriate forbearance period?
Well, some of your examples, Ken, are apt depending on the kind of business. What I like to explain to my lender clients and to borrowers that we're talking with is that there seems to sometimes is a misconception that the forbearance agreement, if a borrower is in trouble and a loan is either in default or headed that way, well, let's just get everyone into a forbearance and we're all good. What I like to explain is a forbearance really is only a bridge to something or to somewhere. It's a way to bridge that gap, to provide an operating cushion or breathing space for the borrower to continue to operate before there may be an exercise of remedies or they have to pay off the loan. So the key in determining the length of a forbearance and the forbearance conditions is, what are we bridging to? Is it a sale? Maybe setting up for a sale when your company may be involved. It may be a business reorganization and a restructuring of either operations or debt that needs to take some time. Sometimes you have external factors. You have tax questions. You have other external parties who may have leverage over a company that someone's negotiating with them, and if you can get this tax levy reduced, for instance, maybe that will help your operations. So again, you have to keep in mind, what are we trying to achieve that's going to either return the borrower to profitability or get them ready for a sale. And that's really a borrower's decision. Again, that's where the lender is not the one making that decision. It's not the one putting together the business plan. But once the parties have agreed on what sort of a plan it should be, what the milestones are, then the forbearance really can be tailored to that. The only other caveat to that, of course, is sometimes with a bank, particularly regulated banks, you may have regulatory pressure to make a forbearance period shorter than that's required. But those are typically the factors you would look at.
Okay. In a forbearance period or otherwise, if this troubled borrower finally takes some action and retains somebody to either sell the business, or maybe they retain a crisis manager to help right the ship, what can the lender do to make sure that that process is transparent, and also that it's not just being used as a stall to make it look like they're doing something?
It's important to negotiate and have in writing and in an agreement what the exact duties and responsibilities and rights of the CRO or the crisis manager, financial advisor, whatever the role is going to be. What role will they have? Who will they report to? Do they have ultimate, say, check writing authority on their own, or do they have to run it by other management? Does the CRO report directly to the board? How frequently? And also, the CRO ought to be able to talk with the lender freely. The lender ought to be able to talk with the CRO freely. And whether that is on an ad hoc basis or on a regular basis that's scheduled, you want to understand and be able to, the lender wants to be able to really get directly from the horse's mouth, as it were, what's going on at the company, and are they listening to you, and are they implementing the tactics that you have, would like them to do. So it's a lot about reporting, keeping up with the CRO, and getting frank feedback from the CRO that, look, the owner of the business isn't doing what I'm telling him to do.
Right, okay. Anything else in our closing minutes here that you would want to advise lenders or tell them about?
Well, earlier is always better. One of the downsides of the recent lending environment, when in the competitive lending environment, where lenders have gone either to no covenant loans or what people refer to as covenant light loans, is that the lenders frequently have less ability to really monitor the underlying business conditions of the borrower. And so if you are in one of those, of course, it's harder, but you have to keep track of the borrower's business, really study their financials to understand whether there's early signs of trouble. And otherwise, if you have good covenants, you need to monitor those and be ready to act early rather than late when the borrower still has options that it may not have if it waits too long.
Excellent. Well, we appreciate you taking some time to sit down with us. If somebody's heard you say some things here today but needs to dig a little bit deeper into this topic, how can they best find you?
Well, you can always go to our website, which is phrd.com. Or give me a call, 404-420-4331. Thanks.
Thank you. I hope you enjoyed today's interview and were able to come away with at least one very useful piece of information. Please keep your eye out for emails from us announcing future guests and other topics of interest. Please feel free to reach out to me if I can be of any assistance at the email or phone number on the screen. As well as if you have a topic that you'd like to hear about or want to make any suggestions for a guest expert. Thanks again.